over 80% of central banks around the world are exploring the opportunities offered by a kind of digital currency. Formerly, they're referred to as Central Bank Digital Currencies, or CBDCs for short. It's not exactly the easiest thing to roll off the tongue, but keep that in mind because you're going to be hearing a lot more about it in the future. The thing is, though, small economies in the Caribbean, in Africa, they're right at the forefront of this exploration. The Bahamas, for example, became the first country in the world to roll out its CBDC. It's known as the sand dollar. Within the continent, 6 countries are exploring CBDCs. That includes eSwatini, Mauritius, Rwanda, South Africa, and Kenya. All of those are in the research stage. Ghana, of course, is developing the e-Cedi. But what exactly are CBDCs and what makes them unique compared to, say, traditional crypto? Well, among other things, they're issued directly by a central bank, and unlike, say, Ethereum or Bitcoin, they're backed by the country's FX reserves. But like those cryptocurrencies, they run on blockchain tech. And depending on the design, the central bank can see significant amounts of data on transactions flowing from one party to the other. They can even set limits in near real time on transaction prices and volumes. Perhaps they can even decide if a CBDC should be interest-bearing or not, and much more. Central banks across the world clearly are very interested in digital currencies, but you've got to ask, what is the attraction for small and frontier economies?
They have a unique set of circumstances where really the central bank digital currency really fits well with their needs. It's able to provide financial inclusion to people on remote islands that don't necessarily have easy access to a physical bank, particularly after a hurricane or a storm. So they have that access to continue their transactions without the physical bank being there. They also have, a lot of small states are really impacted by correspondent banking losses and de-risking, and central bank currencies is a form of response to that.
Okay, so how then do we deal with the competition or potential conflict of interest issues? Because when I hear central banks saying this will make payments a lot more efficient, the corollary of that is that it might imply that the central bank is getting into the payment space as well to some extent. If you're talking about a CBDC that's essentially aimed at the retail space, not the wholesale space. So how do we deal with that competition issue?
I think it sort of depends on how the central bank itself sets up the parameters around the introduction of this technology. So, the way that it's being done in the Bahamas, which is one of the few examples that are out there. A lot of this is a lot of theoretical talk at the moment because there aren't that many that are actually really engaged. But in the Bahamas, the way that it's been set up, it is very contained. So no one actually holds any deposits with the central bank itself, but really, you get the currency through third parties. There's a cap on the amount of money you can hold in your wallet and the number of transactions that you can do within a particular period of time. I think it's about a month. You can do a certain number of transactions a month. And so, it really, the risks and the benefits depend on how this is, how the regulator has set it up and what they want to get out of it and how they sort of control the use of it or not. So it really depends really.
And I know I'm stretching this a little bit into deep theoretical territory, but in an environment where the central bank, in theory, could essentially issue these wallets, it could handle the tech end of it for distributing these e-wallets, see who has got how much money in their wallet and what transactions are made across specific amounts of time. They could set up negative interest rates, perhaps as real-time incentives to convince people to get out there and spend money. In that sort of environment, then what are banks good for?
I mean, that's a good question, and I don't know if I think that any central bank is necessarily interested in competing with commercial banks or interested necessarily in getting involved in that aspect of it and that end of it. But there's only been there aren't many examples to draw on here to really say definitively what they will and won't do, but there are a lot more countries exploring it and a lot more, I would say, developing countries that are taking it a bit further, faster than your advanced economies are. And I think really they're looking to address this financial inclusion gap
could the argument be made that this is just also partly a response to what we've seen in the last 2 years, the rise of cryptocurrencies like Bitcoin and Ethereum being used for transactions, but also as a speculative asset class, but just as important as a response to the potential loss of monetary sovereignty in the face of cryptocurrencies like Libra, or Diem as it's now called, being brought to market by entities like Facebook?
I mean, I definitely think there is an argument to be explored there. And I think that it's without a doubt that, the growth of these currencies, particularly Facebook's Libra or DM, as you said, has really driven central bankers to act. Whereas before they were, taking it slowly, weren't paying that much attention. But I think it's not as simple as just to say that this is just a response to that, a reaction to that, because really they could easily ask the government to legislate in a certain way to ban the use of cryptocurrencies. But I think central banks are seeing the value that this new technology can bring, that digital currency can bring, and they want to get the best out of that. And so while it might have been, while these other currencies might have spurred them on, I think they also see that there's an inherent value to make payments and the financial sector a little bit faster, a little bit cheaper, a little bit safer, and more accessible. And I think that they are really trying to capitalize on that as well.